So the bears fired a shot across the bow earlier this week. Does that mean we're headed for a correction? Let's look at the charts and find out. Hey, this is Arthur Hill. Welcome to Next Level Charting. I'm the Chief Technical Strategist at TrendInvestorPro.com. And today I want to look at the progression that we saw over the last few months that led to the real possibility that we're going to see a corrective period in the coming weeks or months. First, we had a normal advance, and then we saw this advance accelerate in mid-January, and that was the sign of excess. And now we've had the first shot across the bow, and I think that means we're going to start some sort of a corrective period, and I'll look at some potential targets for a correction should one unfold. So the most interesting thing about January 2020 was how closely it was paralleling January 2018 2 years ago. And I'm not just talking about January in 2018, but the lead up into January when you went from a normal advance to signs of excess in January 2018, and that led to the correction. So what I want to first do is back up and show you what happened in the lead up to January 2018 and how we identified the signs of excess. Now, history doesn't repeat itself, of course, but it does rhyme, and that's what I want to show. If you look at the S&P 500 SPDR, SPY here, you had a normal advance from August until December. And sure, it was maybe due for a correction in October and maybe in the latter part of November, but it didn't correct. And if you look at that advance, the structure, each weekly gain is not that impressive in and of itself. You can see there's the weekly rate of change. It doesn't get above 2%, which is the red line, until January. And then you start getting these outsized gains. Look at these 4 big candlesticks. And then 2 of those candlesticks were clearly outsized, and the weekly gain was above 2%. As you can see, the rate of change indicator at the bottom getting above 2%. Now, there's a big difference between an outsized gain after a pullback and an outsized gain after an advance. After a pullback, an outsized gain, which is a bigger than average gain, a big gain, can signal a trend reversal. But a bigger than average gain after an extended advance signals a frothy market. It signals excess in the market. So there were 2 signs of excess right there. First, the candlesticks, the longest white candlesticks of the advance. You can see all of these were smaller. And then you get these 2 biggest candlesticks there. And then we got rate of change above 2% twice. First time since the advance began. So that was excess. And then we have the PPO. And this is the 40-week EMA. And the PPO got above 10% 3 times there in January 2018. So that basically meant that the close was more than 10% above the 40-week moving average 3 weeks in a row. Actually, it wasn't that first week, it was the second 3 weeks there. And that was a sign of excess. So now let's look at January 2020. And as I said, history does not repeat itself exactly, but it does rhyme. And if you look here, first of all, there we have the slow and steady advance. There's nothing special about this advance other than the fact that it extended over 3 months and we saw a double-digit gain. But what happened here in mid-January was you had kind of an acceleration. You had the 2 longest candlesticks of the entire move. So that was a sign of excess. The 1-week rate of change hit 1.9%. It didn't exceed 2%, but you can see this was the biggest advance since the advance began there in middle August. So you had an outsized advance basically, you had outsized candlesticks, and then the PPO hit 9.74%. So that is close enough to 10%. I mean, we don't need exact signals when we're doing a comparison back. We just need a it's usually not one thing that leads to a correction. It's a number of things. And you can see we got the two big candlesticks, we got the rate of change near 2%, and we got the PPO near 40%. So that told us that at this stage right here, the close was 9.74% above the 40-week EMA, and that is a sign of excess. And then we got kind of the inside Harami candlestick there, and we opened weak to start the week this week. So we've gotten the shot across the bow. So now let's look at the correction that we had in 2018 and some corrections in 2019 to see what we might expect. Actually, before we look at the correction in 2018 and the ones in 2019, I want to show you that the market started taking on a defensive tone in December. And I've got a number of defensive names here I want to show you. You can see that utilities got that pop in the middle of December, a little pullback, and then that breakout up 8% in the latter part of January. That's a huge move for utilities. RSI moved above 90, 10-period RSI above 90 for the first time ever. So a big move into defensive-oriented utilities. REITs broke out in the latter part of December and moved higher. So you had money moving into those two defensive names. The gold miners, SPDR, or ETF, got a breakout there around Christmas and a little throwback and another breakout. So you have money moving into gold miners. And of course, that's predicated on the move in gold, which also broke out around Christmas here and a little pullback and a breakout. And these signals, these falling wedges and signals, were noted on trendinvestorpro.com. And then we had bonds. And I featured bonds last week in Next Level Charting. And you had this big move up, this long correction, and we got a breakout in bonds. And bonds are the ultimate safe haven. This is AGG, the aggregate bond ETF. And then this is TLT, the 20-plus year Treasury bond ETF, the ultimate safe haven. And there is the breakout. And we had a little pullback after the breakout. And then look at that move last week. So a big breakout in the making for bonds. It looks like TLT is heading to new highs. So clearly money is moving into the defensive area of the market. Now that in and of itself is not bearish for equities. It's the other setups that we're seeing, the excesses and the shot across the bow, that suggest we're moving into a corrective situation. So now we're going back to 2018, and there we can see the period of excess here. And note, I've switched to a 40-week simple moving average when it comes to identifying potential support zones. And I do mean zones when you're using a moving average. Katie Stockton of Fairlead Strategies notes that moving averages are like cushions as far as support levels are concerned. And you can see a clear cushion here, as we'll show. But basically, you had a rising 40-week moving average. So the trend was still up. The PPO 440 was still positive, and that meant the 4-week EMA was above the 40-week EMA. So you still had a long-term uptrend in play. But then we got this huge decline over a 2-week period, and we actually broke the 40-week moving average intra-week. And then we got a little bounce and another test, and there's where the cushion effect comes in. And look how many times we toyed with that 40-week moving average. But I think the main point was, and what made this a correction was, you were still had a rising 40-week moving average. The PPO 440 was still positive. So your long-term metrics are still bullish, and you were testing this moving average like a cushion. And the fourth thing, or third, I don't know how many I've got here already, was a symmetrical triangle formed. And what is the symmetrical triangle? It's a bullish continuation pattern. It basically represents the pause that refreshes. And yeah, it was a tough pause to sit through, but it's important that you put the pattern into perspective. Look at the prior advance. And I'm just going back to January 2017. It actually goes back, I think, to November. But this is a humongous advance. So a humongous advance is entitled to a correction of appropriate size. And so you can see this is a big correction, and it took 15 weeks to digest this big gain. And we could be in for a multi-week corrective period now where prices either move sideways or down. We'll look at that in a minute here. But this was a 15-week choppy consolidation, and then you got the breakout, and then you had the successful test of the rising 40-week moving average, and we moved on to new highs into October. So that is how 2018 unfolded. So here we are with the present chart, and there are a couple of corrections in 2019, and you can see I've got a box of chocolates here, and that's because you don't know what you're going to get with a correction. All right, we could get that volatile triangle I just showed you before. We could get a shallow pullback, and this was a fairly shallow pullback. You had a big advance, and then you had a shallow, like falling flag pullback. There's the outsized candlestick after the pullback that led to a new high. And then we had the ascending triangle here, and this was 13 weeks of moving sideways. The other type of correction could be a deep retracement. You could retrace, say, 2/3 of the prior advance. So when we look at potential correction targets, obviously this rising 40-week moving average comes into play. And it's currently in that 302 area. And you can see you have broken resistance, and that turns into support. And so, you know, in theory, we could pull back to this breakout zone. And once we start getting around that 40-week moving average, then I think you have to be on alert for a potential bounce. And that's when you start looking for stocks or ETFs that are outperforming during the pullback, because if the broader market turns around, they may be the ones that lead when if the bull market resumes. And yes, I still think we're in a bull market, because I said, if you look at the PPO 440, this is basically the difference between the 4-week EMA and the 40-week EMA. And the only reason I'm using EMAs is because that's what StockCharts offers for the PPO. MACD and PPO are based on EMAs. And when I look on the chart for the S&P 500 or SPY, I'll use a 40-week SMA or a 200-day SMA. I think the S&P really respects its 200-day SMA, and the equivalent, not the exact, but the equivalent is a 40-week SMA. So anyhow, the 440 PPO is positive. So that tells you there's still a long-term uptrend, but it did get excessive, and we got excessive here. So in some way, shape, or form, we could work our way back towards the 302 area. I don't know if it'll be a sharp decline. I don't know if it'll be a zigzag or a sideways consolidation. It just seems to be a box of chocolates right now. And I keep saying that, and I'm probably going to say it one more time. But we got to keep an open mind and let the correction run its course. So as I said, corrections are like a box of chocolates. You never know what you're going to get. And that is all I have to say about that. If you want to tune into Next Level Charting, we're on every Thursday at noon Eastern Time. If you want to know more about Arthur Hill and my ETF strategies, you can visit trendinvestorpro.com. Thanks very much for tuning in, and have a great day.